Thank you for standing by, and welcome to the Regis Resources Limited fourth quarter update. All participants are in a listen-only mode. There will be a presentation followed by a question and answer session. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I will now like to hand the conference over to Mr. Jim Beyer, Managing Director and CEO. Please go ahead.
Thanks, Mel, and good morning, everyone, and thank you for joining us for the Regis Resources June quarter FY26 results. Joining me on the call today are our CFO, Anthony Rakicki, our COO, Michael Holmes, and our Head of Investor Relations, Matt Collings. Now, through this session, we'll refer at times to figures and tables in the quarterly report and the FY27 guidance that we put out last week, so you may find it useful to have those documents at hand. I'll kick off first with safety. During the June quarter, our operations continued to perform strongly from a safety perspective. The 12-month moving average lost time injury frequency rate finished the quarter a little bit further down at 0.3, which continues to be well below the Western Australian gold industry average, which is always a bit delayed in its timing, but is currently running at around 1, which is from nearly 2 years ago. We continue to focus on leadership, discipline and continuous improvement to support safe and reliable operations across our business. And this is in support of our objectives to provide a workplace that's free from serious injury. Turning now to production performance, delivery to plan through FY26 has been consistent, and the June quarter was a standout performance for both Duketon and Tropicana. Operationally, the group production for the quarter was 101.5 thousand ounces, at an all-in sustaining cost of $3,244 an ounce. And that was carrying a non-cash charge of $181 an ounce. Our annual production hit the top end of guidance at 379. The top of guidance was 380, so pretty well bang on the top. The consistent delivery of production and costs across our operations, despite some macro headwinds since March, has seen our cash flow continue, along with our returns to shareholders. During the quarter, Regis increased its cash and bullion by $56 million. And note that that was after the payment of a 15-cent share, fully franked, for $114 million in dividends and also $64 million in tax. And Anthony will talk some more on this in a moment. The Regis cash and bullion balance remains at a competitive advantage for our business at almost $1.2 billion at the end of June. An increase of $667 million for the full year, and that was after paying a total of $151 million in fully franked dividends and $156 million in tax payments. To maintain this momentum, Regis remains unhedged and continues to invest in growth and exploration, and thanks to a strong operational performance, has the capacity to balance disciplined investment and reinvestment with our returns to shareholders. Our message and our actions remain consistent. Regis operates quality assets, strongly leverage the gold price, and we have a disciplined approach to investment and capital returns. And I'd like to think that you've seen some of this disciplined approach in investment reflected in our decision not to continue in the bulk sale process. So back to where I was, Regis operates quality assets with strong leverage into the gold price, as I said, and a disciplined approach to investment and capital returns. And combined with the continued rolling life extensions of our underground mines, as demonstrated in a recent exploration update and this year's R&R report, we're extremely well positioned to consistently deliver ounces and cash flow well into the future. With that, I'll now hand over to Michael, who will then subsequently pass to Anthony, and both of them will provide details on our operations and our financial performance. Over to you, Michael.
Thanks, Jim, and good morning, everyone. Operationally, Regis finished the year strongly with safety, focusing on the critical hazards, supervisor interactions, and a workforce-led safety program. We will continue these programs, striving for further improvements in FY27. The June quarter for production was in line with expectations across both Duketon and Tropicana, and this meant that we finished at the top end of guidance for the year. In line with our strategic pillars, reliable delivery, Our teams continue to consistently execute the plan across the business, and this remains a key strength for Regis. At Duketon, open pit and underground operations produced 62.5 thousand ounces. Open pit mining continued at King of Creation, the Moolart Well laterites, Ben Hur and some minor pits delivering 25.9 thousand ounces at an average grade of 0.85 grams per tonne, and the performance was in line with plan. Our underground operations at Gardenwell and Rosemont continue to perform reliably, producing 37.6 thousand ounces at 1.99 grams per tonne. Development rates across both undergrounds are pleasing and supported steady ore delivery through the quarter, as well as unlocking future production sources. Total underground development at Duketon was 3,803 metres, with approximately 50% classified as capital development, reflecting investment in Gardenwell Main and Rosemont Stage 3. Rosemont Stage 3 development continues and is progressing as planned towards commercial production. During the June quarter, we continue with the advancement of the underground Rosemont Stage 3 underground, the construction of the Gardenwell paste fill plant, which is planned for commissioning in quarter 2, which is key to increasing the ore body recovery in the future. And spend was also done on the Buckwell open pit. Both sources have the potential to provide gold production for the next 5 years, with Rosemont ore body continuing further to the south. At Buckwell, pre-strip mining rates continue to exceed expectations, with the addition of a large 3,600 tonne digger to the open pit fleet, proving its worth. The higher productivity reduced unit mining rates and allowed for the accelerated development, bringing forward ore exposure. The Duketon mills performed to expectations, with open pit and underground ore feed supported by planned stockpile feed. Now turning to Tropicana. At Tropicana, Regis attributable production for the quarter was 39.1 thousand ounces, a very strong quarter to finish the year. Open pit operations delivered 21.9 thousand ounces at an average grade of 2.02 grams per tonne, with performance in line with expectations. Underground operations delivered 13.2 thousand ounces at 2.97 grams per tonne, again consistent with plan. Tropicana mill feed was a combination of the open pit, underground and supplemental stockpile feeds. Overall, both Duketon and Tropicana continued to perform reliably during the quarter, delivering consistent production while progressing key underground and near-term growth projects. With that, I'll now hand over to Anthony to take you through the financials.
Thanks, Michael. Good morning, everybody. As Jim outlined earlier, the June quarter was a fitting end to a very strong financial year, with consistent operational delivery of high margins, which converted into significant cash generation. Gold sales for the quarter were just over 102,000 ounces for an average realised price of $6,241 an ounce, generating $639 million in revenue. Operating cash flow for the quarter was $376 million, with $194 million generated at Duketon and $182 million coming from Tropicana. Also in cash and bullion, and referring to figure 2 in the ASX release, the piggy bank grew in size by $56 million during the quarter, taking the total balance to $1.2 billion as at the 30th of June. Now, that cash build might not look quite as much as we've delivered in previous quarters, but importantly, the $56 million increase was achieved after the payment of $114 million in dividends and $64 million of tax instalments. For growth and sustaining capital, we spent $131 million in the quarter. At Duketon, this included underground development, pre-production mining activities and waste removal, as well as investment in plant and equipment. A significant portion of this spend related to the mine development of Gardenwell Main, Rosemont Stage 3 and Buckwell. At Tropicana, expenditure related mostly to underground development at Boston Shaker, pre-production costs at the Havana underground and sustaining capital across the operation. Exploration expenditure during the quarter was $18 million, reflecting the continuing high levels of activity across both Duketon and Tropicana. and $9 million was spent during the quarter at McPhillamys, remembering McPhillamys costs are expensed through our profit and loss account. Now, jumping back to my earlier mention of tax instalments, there was $64 million of that in the June quarter, whereby we commenced monthly instalment payments in April. These payments have been approximately $20 million per month and are forecast to remain at that level for the rest of this calendar year 26. A final catch-up tax payment is forecast for the December quarter this year, the value of which is being estimated and will be included in our 30 June 26 annual financial report, which will be released next month. And as a final point, I note that we received the Volt transaction break fee earlier this week, amounting to just over $50 million. So that's most of the headline results from me, and I look forward to providing you with our full suite of financial results in August. Thank you, and now I'll hand back to Jim.
Thanks, Anthony. Now, we've gone through the quarter in a bit of detail, but let me pull the year together for you. The first point is capital management. Alongside our half-year results earlier this year, we introduced our new dividend policy whereby Regis expects to pay fully franked ordinary dividends on a semi-annual basis, having regards to its prevailing cash and bullion balances, of course, business cash flows, the available franking credits, and capital allocation priorities. But in particular, the ordinary dividend payments are expected to represent between 25 and 50% of the group cash increase over the preceding half financial year. And this quarter, we paid a fully franked interim dividend of 15 cents a share, as I mentioned before, for a total of 114 million returned to our shareholders. I think the policy makes our intention clear to be reliable but responsible dividend payer. I would note that with that estimation modelling, with regular tax instalments now a fact of life for us, the adjustments for tax accruals should become less material over time and the forecast much more simple. Importantly, our dividend payments have resumed, all the while remaining unhedged, investing in growth and exploration, and still building our balance sheet, up $667 million this year, and that's even after dividends and tax now. Now, the second point that's worth noting is our growing resources and reserves. Our group update this year showed mineral resources up 10% year on year to 8.3 million ounces, while our ore reserves were also up nearly 20% to 2 million ounces. And this is to the end of December, 31 December 2025, before we reinstated the 1.9 million ounces of ore reserves from McPhillamys. Our underground mines continue to deliver with increasing reserves and also are showing their potential. The sections in the release of Garden Well and Rosemont, and I think they're figure 4 and 5, the Garden Well, 4 for Garden Well, I think, and 5 for Rosemont, really illustrate the growth in both volume and confidence, and the mid-year exploration update only reinforces it. What is particularly important to observe are the holes in a down plunge that show good intercepts. Garden Well Main has a hole 10.4 metres thick at 2.9 grams a tonne, and that is 500 metres down plunge from the nearest resource modelling. And this is really pointing to the sort of continuity that we see at Tropicana. Garden Well South is similar. It's got an intercept 3.9 metres at 4 grams a tonne, about 300 metres or so down plunge from nearest resource modelling. These are exciting and telling results, and anyone who thinks our undergrounds are short in life, I would ask that they carefully consider these results. In addition to the underground, we have the initial 270,000 ounces of resource or mineral resource declared for the new discovery at Beamish South, with drilling still continuing. We've seen great progress at Ben-Hur, where the step-out drilling has shown mineralisation continues well outside the current resource shapes. A key point to note here is that at Beamish South, that 270,000 ounces, that is a new or a fresh greenfields type discovery. It's nearby. The interesting thing is it's nearby to existing pits and infrastructure, but it's not an extension. It's greenfield like. The valuable outcome illustrates how our refreshed exploration strategy confirms that opportunities still exist at Duketon in areas previously considered to be unprospective. And what it does is it validates the decision to lift our exploration spend back at Duketon back in December last year, in the December quarter. So despite what some might say about the mine life at Duketon, the reality is we keep adding life year on year. In fact, if you look at the Duketon reserves at the end of 2025, they're essentially unchanged from 2021. So they're sitting at the same level, which I think is just around about 1.4 million ounces. And in that time, we've pulled out 1.2 million ounces of production. And the great thing is that our exploration team and our ResDev team have got a pipeline of targets at Duketon, and we intend to chase them. At Tropicana, the good news keeps on coming too. The operation has delivered extensions to known mineralisation at Boston Shaker, the Tropicana underground and the Havana underground, and also in the Swizzler area. This is building the underground pipeline and reinforcing the long value that we see at that asset. On McPhillamys, as previously flagged, the judicial review of the Section 10 declaration has been heard, and the court has reserved its decision, and we sit and wait. In parallel, we made real progress on the alternative permitting pathways during the quarter. We released the PFS back in June, and that supported the reinstatement of ore reserves at 1.9. It confirmed 1.9 million ounces, and it confirms a robust project with the integrated waste landform, the electrical transmission line, and the water pipeline being granted state significant infrastructure status in New South Wales. So should the judicial review succeed, the TSF pathway is from the 2024 DFS remains our preferred option at this point. But either way, we have a permitting pathway and we're pushing ahead, and we're targeting a final investment decision in the first half of 2028. The work at McPhillamys continues methodically, broadly speaking, on plan and on budget. Now, finally, some comments on guidance. FY26 landed where we said it would. Production at the top end, while all-in sustaining cost was also towards the top end, impacted, of course, by the diesel prices, as everybody understands, but also impacted by our decision, which we flagged and telegraphed clearly, to pursue opportunistic production ounces through the idled Moolart mill. Something that I hope everybody sees and understands as sensible in the current coal price environment. And these factors, of course, carry us through into FY27 guidance, which we released last week. Pursuing these opportunistic ounces has allowed us to declare a production growth and a range of 360 to 400,000 ounces for the group. Now, also with our all-in sustaining cost guided up, driven by factors that I mentioned before, the fuel, as I said, the diesel, and also the increasing proportion of the Buckwell ounces. And we're also seeing a different proportion of ounces coming from Duketon and Tropicana compared to FY26. In conclusion, to summarise, Regis has developed another quarter of consistent production, capping an FY26 that hit the top end of guidance at 379,000 ounces. We continue to generate strong, reliable cash, underpinning a competitive balance sheet and our commitment to responsible capital returns. Our resources and reserves keep growing at both Duketon and Tropicana, giving us an ongoing pathway to extensions well into the 30s. At McPhillamys, we continue our dual path process, progressing the IWL technical work while we wait for the outcome of the judicial review. And FY27 guidance points to higher production for the group, underpinned by Duketon and the fantastic work of the operations and the exploration team at the site. Overall, Regis remains very well positioned to keep delivering long-term value to our shareholders. So with that, thanks for listening and your time. I'll hand back to Mel, who will open the floor up for Q&A.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from John Sharp with JP Morgan. Please go ahead.
Yeah. Hi, Jim and team. Thanks for taking my question. Or questions. I have two questions. First one, just on costs. Group all sustaining costs came in within guidance, but at the top end, and 4Q was much higher. So just trying to understand, I know you said there was some diesel impact there, but just how much of that is diesel impact? And are there any productivity impacts over in WA with maybe contractors? And how should we sort of think about this? Is it temporary or structural?
Well, I certainly wouldn't say that the pressure on the costs came from productivity issues per se. I don't think that was a key point for us. Certainly the costs in the fourth quarter were significantly impacted by diesel. I think in the prior 9 months we were paying about $1 a litre, and in the last 3 months of the year, from April and May, we were paying $2 a litre, and I think we were paying about $1.60 or something like that, or $1.30 in June. And as a result, for that quarter at Duketon, the costs were an additional $300 an ounce off the back of that diesel price, and for the group it was $220. So there wasn't much we could do. There was no restrictions with our availability of diesel. It was well supplied, and our suppliers have been doing a great job keeping us topped up, but it was expensive. But of course we have, as everybody's seen that come off. I think we've assumed about $1.35 for diesel price for this year. So that year on year, that alone accounts for about $135 an ounce increase, if everything else was unchanged from one year to the next. So I think diesel was a big impact. Up $100 an ounce for this year, all things unchanged. But the productivity piece is not quite so material.
Okay, great. No, I didn't think. I just had heard in WA there had been high turnover of contractors, but maybe not impacting you guys. And then just second question. Now with Volt no longer happening, how do you think about the strategic plan from here? You're sitting on quite a bit of cash, strong free cash flow. McPhillamys is some time away from FID. So what are your priorities, Jim? Are you looking elsewhere, or focusing on accelerating organic growth? And how do you think about that sort of buy versus build? Thanks.
Yeah, good question. Certainly, we look at McPhillamys as being something that's close, but not so close to be sitting around and waiting for it. And in any event, our job is not to assume that McPhillamys is the best investment opportunity that we've got. Our job is to go out and continue to look. It's not as if we've just started, but continue to look for capital opportunities that might be a better return. And we'll continue to do that. Obviously, Volt was disappointing, but, frankly, not a real surprise for us that the things played out the way that they did. But we understood that risk, and we felt that it warranted it, but we weren't going to get involved in any kind of bidding war. You talk about how do we think about things. The number one thing that we consider in anything external is it value accretive for our shareholders? If it isn't, if we can't see in a way that through an acquisition, be it an operation that's underway, or be it a new construction project that we could put in front of McPhillamys, it's got to be value accretive for our shareholders. Not really, we think about the others, but that's not our responsibility. And if we think that it's value accretive, then that's something that we give serious thought to. If it isn't, and it's destroying value for our shareholders, and we can't see any way of it making any sense, we just won't do it. And are we looking? We were looking before, and we're looking again. Obviously a little bit of disappointment, but as I said, not a huge shock, just disappointing. We think we've made the right decision. We've demonstrated over the years I think we've demonstrated to the market, Tropicana, we got a lot of criticism that we invested in that. And look at it now, I think we've got all our money back and we've still got years of life left in it, or pretty close to it. So that was a critiqued investment that actually has turned out to be an absolute cracker. And now we exercise sort of similar discipline and understanding. We like the assets, but not enough to pay any more than we already had on the table. And so we exercise discipline and not going off like irresponsibly. The reality there was we just couldn't match the synergies that were real. So we'll continue to look. We'll continue to apply that discipline and see what we can engage with.
Thanks for your insights, Jim. I'll pass it on.
Thank you.
No worries. Thanks, John.
Your next question comes from Matthew Friedman with MST Financial. Please go ahead.
Sure. Thanks. Morning, Jim and team. Firstly, can I dig into the FY27 cost guidance at the asset level in a little bit more detail? If I look at your Tropicana guidance, the midpoint is about 10% higher than what you just delivered in Q4. And then conversely, if I look at your Duketon guidance midpoint, it's about 10% lower than what you just delivered. So obviously across the group, diesel a pretty significant driver there to that sort of elevated Q4 base as you've just discussed with John. But maybe can you expand on the differing drivers between the two assets looking into FY27? Is that predominantly a denominator effect of production and the mix of production sources across the two sites, as I think maybe you mentioned, or is there anything else in particular in terms of mining sequence or, differing cost inflation effects between the two sites going on there? Thanks.
Yeah, thanks, Matt. I'll keep it pretty high level, right? Tropicana is reasonably straightforward. You've got a lower denominator. It's a lower production, similar cost base. That's just a nuance of the year. We're not producing as much from the pits this year, which means we're taking more from the stockpiles. It's just a sequence in the pits that sort of starts to swing the other way in subsequent years. So, we're not running around in circles panicking about it. It's just one of those scheduling things that you got to live with. But nothing there that's causing any dramatic trends that we worry about, unnecessarily. In terms of Duketon, yeah, look, I guess certainly relative to last quarter, the big difference, as I said, is the fuel. The fuel has had a significant impact at Duketon alone. I think we're pushing it up $130 an ounce. But the other thing to recognise too is that as a proportion of our production, we take a step back, and we actually think Duketon is a good story because we'd always envisaged it being somewhere between 200 to 250,000 ounces per annum, and this year it'll be above that, and that'll be thanks to Buckwell. But of course, Buckwell comes with higher costs, as we've sort of belabored the point. So that's dragged up Duketon a little bit as well. So it's not these are with the if we wanted to reduce our costs, we'd just shut down Buckwell and we'd see our all-in sustaining costs dropping. But why in the blazes would we do that? Because those ounces at today's price still make good money. So we'll just keep running that plan. We think that Duketon continues to play out I think the Buckwell investment, you have a look at it, you can see in one of our old releases, even at a pretty modest gold price, it's 121% internal rate of return on a project. So we like it. We're prepared to sort of answer the questions on why the costs at Duketon going up, and it's quite sensible. We're utilising a plant that was underutilised. We're putting through lower grade, high cost ounces, but we still make good money on it, and why wouldn't we? So they're really the key things that are driving up FY27 or driving the FY27 unit costs.
Yeah, got it. Thanks, Jim. Maybe a quick follow-up then on your comments on Tropicana. You talked about the lower denominator in FY27, or the lower production, I should say, in FY27 being a function of, I guess, the sequence of the open pits and, swinging the other way in future years. Is it right to say, in terms of our thinking, that, potentially that kind of lower open pit production, that's maybe a sort of 12 or 18 month story, and then, as you said, it swings the other way for, again, maybe another sort of 12 or 18 months as that final sort of open pit life depletes? Or, is that the sort of 3-year journey, or is there anything I'm missing there?
Yeah, it's probably not that long for the open pits without us finding more material. But there's definitely, just in this 12 months, we're seeing it's a cycle scheduling thing, and I am anticipating that in subsequent years we'll see it swinging up. It's not going to be a wild swing. I mean, we're not going to see twice as many ounces out of it, of course, but it'll be back to similar levels that we've seen in the past. While the pits, Havana 5 and 6, the other stages all start to run out, or run out, run through.
Yeah, got it. Okay, thanks for that. Maybe finally, second question on McPhillamys, the FID decision that you've kind of penciled in for the first half of 2028. Again, at a high level, can you talk through, I guess, what work needs to be done to, I guess, complete that DFS and bring the project to an FID point? What are the key work streams, I guess, given that really most of the study, as I understand it, is fairly well unchanged from the 2024 DFS. So I guess the question is, could that FID decision, or could those work streams be accelerated, in the event that you got some kind of early resolution on the judicial review? Thanks.
Yeah, look, I'd like to think that they could, but what I think and what actually happens sometimes don't always align.
Yeah, you and me both.
Yeah. Look, I think fundamentally, really there are two different ways that the project will go. We'll either go back to this gravity-based tailings disposal, where gravity settles it all out, or we'll go to the integrated waste landform, or this form of co-disposal in the waste rock dump. The judicial review will, when we do get an answer, it actually won't be all bets are off and we're off to the races again. The way that the process runs is the judge, and we obviously think there's a reasonable case for it, but the judge will say, well, it was an unfair process and it needs to be rerun again, and the decision gets set aside. It doesn't get overturned. So the new Minister White, would presumably get the department to go back, right whatever wrongs the judge felt didn't happen in the process, do the review, and then reconsider the application by the group, and also no doubt consider the comments that come from the Orange Lands Council, who have got more than a vested interest in that part of the world, more than probably arguably anybody else, but on the heritage front. So that we don't expect that to happen quickly. I would anticipate that could run well into next year, for that work to be redone, revisited, and to be done in a manner that everybody is comfortable won't also go through another challenge, right? So, we, on the co-disposal side with the IWL, we would have to, we've still got to, it's an application of known technologies, but it's new to the state of New South Wales. So there's quite a bit of work that we're doing with the department to satisfy the really quite important aspects of the design and the implementation and the operation of that land waste mass or waste landform, to make sure that it's appropriate and it's safe in its design. That too takes time. The other interesting little bit that just popped up in the middle of all of this is just because time drags on, thanks to all of these issues with permitting and approvals, there's a little part of our water pipeline that a group was going to, wanting to build a renewable energy farm on top of. So, we got pushed around a bit there, so we redirected our pipe by 10 or 15 kilometres or something like that. We have to get that all checked and confirmed from an environmental and heritage point of view, which is what we're doing now. Again, it just takes time. Of course, the irony is that whatever that farm was, last thing we've heard is that they don't have funding anymore. So, but we've made the change. So all of those things, Matt, are all pointing to us saying, regardless of whether we'd love it if the Section 10 was overturned and a new decision made quickly, but realistically we think that'll take time. If we do get a negative response there, we've still got work to do to get the final tick off of confidence that we're going to operate it and run it right. We've got the designs right for the IWL, and all of that's just pointing to tell us that don't expect anything before the end of next year, calendar year. So therefore we're looking and thinking, all right, well, that'll be early 28 for FID, first half of 28 FID. So, we could push it and run harder, but it's probably more important just to pace ourselves. And of course, if the Section 10 is successful, then, we'd probably drop the other work that we're doing. Just focus on it.
Got it. Thanks, Jim. Yeah, no, it sounds like either way, 18-ish months plus is a hopeful outcome either way. So,
yeah,
that sounds good.
That's pretty much the way we view it.
Thank you. Your next question comes from Adam Baker with Macquarie. Please go ahead.
Hey, morning, Jim. Just maybe following up on your comments to John, just on the growth aspirations and pressing you a little bit further here and on the inorganic front in particular. Just wondering, and obviously you look at all assets which might potentially come to market, but in your view, what could Regis add the most value to? Are these old assets which might require reinvestment and turnaround, or could you potentially look at resource and development stage assets which could compete for capital against McPhillamys? Thank you.
Yeah, good question, Adam. The answer is, well, yes, both. We have an ability to understand how to build plants that are fit for purpose in terms of, our plants at Duketon are good for the type of, they're low cost, relatively cheap plants. So is there an opportunity for us to apply that somewhere? McPhillamys is a different, we've obviously just got quite a bit of experience in the engineering side there, and individuals in the team have got experience in the much bigger size plant in a complex area. Look, we look at them all. It's pretty hard for me to be any more definitive than just, publishing a list of the things that we look at, which obviously we're not going to do and can't do. But would we look at a project that is waiting to be built? Yes, we would. We'd probably take a very careful view of how well permitted that project is, because there's plenty of, interesting looking projects or resource projects around. But are they late in the permitting process and almost there, or just beginning, or naively sitting in the middle thinking that they're just about to finish, but not really, because experience tells us that it takes time. So that's certainly something that we look at with projects. In terms of operations, yeah, definitely we're looking to see whether, there's some, one of the benefits of building your portfolio of operations is you can take assets and bring them in, and where they might be regarded as being, volatile in their production, or, you put it in a portfolio and you start to have the ability to manage the risk by consolidating. So we look at those as well. But once again, I revert back to, I think it was the question that John asked. We look at a lot, but it's got to be value accretive for our shareholders. That's the first filter it's got to go through.
That's clear. Thanks. And Just on Boston Shaker, some pretty encouraging down-dip extensions to the inferred resource there. Just a quick one, if you can remind us when we should be expecting an R&R update for Tropicana.
Yeah, I think Tropicana finished their drilling around about now, but the R&R for Anglo usually comes out early in the calendar year. I think it's usually late January or February, something like that. And then we obviously finish our drilling at the end of, or we don't finish our drilling, we cut off our drilling generally at the end of December, and we put ours out in April, May. But, the Anglo results will come out in February. Or thereabouts.
Thank you. Yeah. I'll hand it on. Thank you.
Thank you. Your next question comes from Levi Spry with UBS. Please go ahead.
Good day, Jim. Thanks
Hi,
for
Levi.
the time. Just two quick ones, please. So just on the growth capital in the guidance for next year at Duketon, can you just tell us where you'll be spending it?
Yeah, look, in broad licks, so we really have there's probably about 150, you've probably got a little bit over half of it, probably 60% or so is just associated with things like the pre-production at Buckwell and a number of other open pits that we're doing work on. There's, we haven't made a final decision, but really, there's a stage 8 that we're looking at for Garden Well, and there's a number of other pits that are just being pre-developed and included in that. And then the rest of it, probably a bit less than 100 million, is tied up with the underground stage 3, the Garden Well paste fill plant, which will be commissioned during the period, I think Michael mentioned. And so that's in bucket terms, that's where it is. I don't see much more value in breaking it down, but, probably about 60% or so is a little bit over that is in open pits and various open pits, and the rest is associated with the undergrounds.
Yeah, got it. Thanks. And just on this new one, so Beamish, when could you, what are the next steps there? When could you get into that?
Yeah, that's a good question. Well, we're working on that now. We're sort of trying to figure out whether it's okay for us to get a design going and pull that into the plan right now, or whether we should let the drills keep going and because it's not, that 270 is not considered to be the end of it. There's still more to do. So we're just, it's probably at least a couple of years away for us to really bring that into the schedule. But, our mills are full, so it'll be, if we do bring it in, and we do bring it in earlier rather than a little bit later in the schedule, we'll be doing it to displace lower grade material rather than a whole new production point on top. We're just working all of that through at the moment, Levi. We're excited about the fact that there's two things that we like about it. Well, there's lots of things, 270,000 things that we like about it actually, but the two things are, it was a really interesting piece of work by the exploration team. There was one hole that somebody had looked at in the past and gone, no, don't understand it, it's nothing here. And the team went back and with all of their fresh understanding, and they looked at it and said, no, this is actually something that fits in with our model. And it was effectively an area that had been, looked over and considered to be a little bit of, the old pasture. And here they go, they find 270,000 ounces and still drilling and still going. And it's right near existing infrastructure. So it's a great story. So I've talked it up, but I just haven't got the detail yet. We're still working on the detail of when we'll bring it into production.
Yeah, got it. Understand. Thank you.
Thanks, Levi.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. We'll now pause for any final questions. Thank you. There are no further questions at this time. I'll now hand back to Mr. Byam for closing remarks.
Thanks, Mel. Thanks, everybody, for joining us. We do appreciate it. As always, if you've got any follow-up questions, please give us a call, give Matt a call, and we'll help where we can within what we can talk about. So I hope everybody has a good day and enjoy your weekend. Thank you and take care.
That does conclude our conference for today. Thank you for participating. You may now disconnect.